audit completion. Okay, what is all about audit completion? Okay, audit completion is actually talking about the audit that actually towards the end. So normally being done by the senior. Okay, and this is at the stage of when you want to wrap up the file. Okay, you want to wrap up the file means that you have actually done all the field work. So now you want to have a final assessment on the overall presentation of the financial statement, as well as disclosure. Okay, has it actually captured all necessary information and so on as per required by the MFRS. All right, so bear in mind. Okay, bear in mind now we are doing audit for 31st December 2020. So when we do the audit for 31st December 2020, all right, what happened is that last time the company is given 6 months. That means if your year end is 31st December, hence the audit must be done before 30th June. Okay, but now it has been shortened. Instead of 30th June, the audit must be done latest by 30th April. So the time frame has been shortened to 4 months. All right. Why is that 4 months? Okay. If you recall back in the framework, MFRS framework, it does mention that the criteria of the financial statement is actually timeliness and relevance. Okay. So you have to remember that when we audit the financial statement, we actually audited the financial statement that actually give you historical information. So it's all information about the past transaction. All right. Of course, if you recall back, okay, what you have learned in management accounting, when you make decisions, okay, future information is relevant, past information is not relevant. Okay. So now we want to increase the value from the audited financial statement. Okay. So that's why we shorten to the 4 months, so that whatever audited financial information presented at the AGM are still relevant and also relevant and also timely lah. Okay, in a way. Okay, so that's the reason why it has been shortened. Okay, and then so if let's say you have not done any interim audit, okay, so whatever that you done after the year end is what we call final audit. Okay, so during the final audit, this is when you do your audit planning, audit field work, and of course the completion part. So completion is always towards the end. All right, and then another thing that auditors must take note is that, all right, one thing is the date of the auditor's report. The date of the auditor's report is the date that when the party such as partner, directors, and also CFO sign the accounts. All right, sign the account. So if you have experience during your practical, the signing page, which is the statutory declaration page, and which is signed by the CFO, and then the statement of directors, which is signed by the directors, and also the auditor's report, which is signed by the partner. Okay, so this is what we call signing page. Okay, so the signing page normally will be signed by the respective party. And then finally, after all parties sign, then normally they will find one particular date when all these parties are physically present in Malaysia. Okay, because sometimes they sign on different date, all right? But because of the passing over the documents around offices and so on, right? So it takes time. Okay, so normally they will come to one particular date that everybody is actually in Malaysia, all right? For those who actually do the signing parties. Okay, so that date is actually important. And then another thing that important is that the date that you issue to the public, okay, which is normally your AGM. Okay, so what happened is that there are things that happen in between that period. Okay, I'm sharing my canvas. Can you all see on the screen? Okay, good.
Yes, madam.
Okay, so what happened is that when we're talking about so this is your year end, which is 31st December 20. Okay, this is the date that you sign auditor's report date of auditor's report. And then this is the date that you issue financial statement to the public. Okay, we are talking about listed company. Alright. So we are saying that there are events that actually could happen here during the course of the audit. Okay, or maybe the course of the audit completed. Okay, or perhaps the audit has completed, but you have an event, something happened here. Okay, or maybe the event happened here, or maybe the event also could happen after financial end. And all these events could or could not have impact, okay, on the financial statement for 31st December 2020. Okay, so as an auditor, we have to assess, all right, whenever all these things happen, all right, is that all this event could have an impact on the financial statement or not? Okay, if there is an impact, then what do we do? Do we need to adjust or do we need not to adjust? Okay, so what are the procedures that involve? So this is actually talking about procedures of audit. Ada ting tong lagi. Sekejap mana saya tadi? Okay, alright. So as an auditor, we have to consider this. Alright, okay. So normally that's why we assess. So first we assess, that's where we assess the materiality lah. Okay, it will go back to your materiality level, the nature of the event. If you think there is an impact, because sometimes when we're talking about impact, okay, the impact might will be impact on the financial statement, whereby you might have to do your debit or credit entry lah. Okay, or maybe it's just to the notes to the accounts. Alright, notes to the accounts. The changes. That means there is no changes on the financial statement, but it's just additional notes that you made to the account. Or even sometimes no impact on the financial statement, no impact on the notes, but it actually changed your audit opinion. Okay, from clean audit opinion to qualified audit opinion perhaps. Okay, so this is where auditors has actually really have to see. Okay, even though the events actually happen after the financial statement has been issued. Okay, so to what extent you want to see your liability exposure? Because if you have not done the necessary, you actually can be caught for not performing your duty of care. Otherwise, we call as a negligence. Alright, so as an auditor, we always like to be cautious, even though events actually happen after the issuance of the financial statement. Okay, alright, so this is actually what happened, and most of the time, all this involve a lot of judgment. Okay, so that's why it's always involve the high rank of the position that actually do. Okay, it normally involves seniors and above lah. Okay, seniors, managers, and partners, right? Especially when it comes to the audit opinion, it's the final say of the partner. Okay, all right. So this is what we want to look at under the audit completion. So coming back here, okay, so we have to understand what actually happened, and hence we have to know how to make a necessary adjustment and so on. So the item that normally involved in the completion will be contingency. Okay, contingency is actually your contingent liability. So contingent liability, we know that from the accounting MFRS requirement, all right. When we have liability, based on the prudence concept, we recognize our liability. Okay, but if we know that we are going to have assets, then normally we don't recognize it. Okay, but sometimes you might want to do additional disclosure in the notes to the accounts. Okay, so I give you an example. Contingent liability is quite a number of events. Okay, because sometimes flooded, like one there's one particular year after year end, nation having high big flood. Okay, so the cars in the compound is actually being new cars yet to be delivered to the customer. Basically their inventory lah. Okay, it's a big flood, so covered the flood covered all the cars in the compound. So what's the impact to the valuation of your inventory? Okay, all right. So in that case, you might want to see. Okay, you might want to assess what is the impact because it's a liability, right? So you want to assess. Okay, you want to assess that. Or perhaps another example, the car is you already delivered to the customer, but at one point of time you call back certain series of the car, okay, because of the failure. So what about the provisions of warranty? Has it actually covered all those things or not? Okay, so you know that if you are going to foresee any liability exposure, that means the company is going to foresee any liability exposure. Hence, and in fact, if it is material, then definitely we would actually ask the client to do necessary adjustment to capture. Okay, but in the case of when you know that the company going to get some like assets, okay, for instance, there is a dispute, there is a court case going on, and you know that your client so-called going to win the case and going to get a certain lump sum of money, okay, from that court, from that case. So do you make a necessary adjustment to your financial statement or not? Okay, so in this case, we don't. Okay, we don't. We only recognize the moment we receive the money. Okay, so again, for contingent liability, because of the prudence concept, we recognize. But of course, it goes back to the maturity level. Okay, then the second thing is that accounting estimate. So accounting estimate is actually, sorry, by the way, contingent liability, how do we come across? Normally we come across when we talk to the legal. All right, so company normally they have their internal in-house legal department, or they might also appoint the third party legal firm, okay, law firm. So you, as an auditor, normally we send these letters, we ask, we query, is there any pending liabilities that the company is actually go through or not, and so on. Okay, because you have to bear in mind, all this not yet being captured by the financial statement. Sometimes we did not know. We only know it after we get a confirmation from the legal department or law firm. Okay, so that's how we capture lah. Okay, liabilities portion. And then estimate. Okay, what is actually estimate? Okay, here you see the words of earnings management. Okay, so what is actually earnings? Earnings is actually refer to your either revenue or income of the business. So what the company do, they manage their earnings. Okay, can we do that? Okay, this is where the creative accounting come in. Right, sometimes you do it in accordance to the standard, in accordance to the law, but actually it is unethical. Okay, because somehow you are not actually reflect the true picture of the company's performance. Okay, so what happened is that some company, let's say this year, okay, this year their performance is really booming. All right, and hence they know that they have like extra, I mean it's already beyond the target, they have achieved the target and it's beyond the target. Okay, so they now start thinking they want to carry some of that earnings to next year. Okay, they want to carry some of that earnings to next year. At least in the beginning of the year, they have some buffer, okay, of earnings to be, I mean, they have some buffer lah. Okay, at least this year they have extra, they want to carry the extra to the following year. Okay, so they do that through accounting entry. All right, so of course this is wrong. Okay, this is wrong because it is actually not reflecting the true picture of the financial statement. Okay, another thing is that when talking about estimate is the fair value. Okay, I'm sure you remember that last time during the last slide when I talk about key audit matters. Okay, current financial reporting standard MFRS very much emphasis on the fair value, impairment of your assets and also impairments of your liabilities. Okay, everything, all your financial assets, all your financial liability must reflect the true picture, okay, of the value of that particular item. Okay, so the question is that, is the value that given by the client or estimates done by the client is actually the correct estimate, or it's just a figure plucked from the sky? Okay, because sometimes when you ask the client, How do you come to this figure? Or I don't know, it's instruction from the HQ. Sometimes you say, oh no, I just think that is the right figure without any basis, without any assumptions. So as an auditor, we have to really check. Okay, so when we have estimate, we must have basis. What is the basis for you to come to that figure? Okay, so the basis can be in the form of contract, in the form of a certain calculation or certain assumptions. Hence, auditor will check or verify those assumptions, calculations, and so on. Okay, so that's why this is where you have to talk to the higher level of management. Okay, so being a junior, normally you are like, you have tried to like communicate to the higher level. So sometimes there is a difficulty. I mean, sometimes clients also cheeky when they know they talk to the junior level and then they will just play with you. Okay, so that's why we have to be smart. That means we have actually, when we work as an auditor, we have to reflect our knowledge. Okay, that means we will actually know what we are doing at our hands. So normally when we have estimates, okay, we actually have to check the assumptions and calculations. Okay, so if let's say they come up with the provisions of warranty, what is the basis of calculation? Okay, so for instance, warranty for what product? Okay, for which part of the car, for instance? Okay, for the engine. So how much is the cost of the engine? How many years you actually cover, and so on. So you have some basis, isn't it, to some calculation. So that's how we go about. So basically, whatever calculation done by the auditor, we re-perform, we reassess. Okay, but if let's say we have no expertise, because sometimes it's involved actuaries, then we import our actuaries come into our team. Okay, for instance, like when those who audit insurance, so they maybe in some area they will actually pass to the actuaries expert to do the checking. Is it reliable? Is it correct or not, and so on. Okay, so that's the role of the auditors. Okay, that means they have to actually assess, okay, regardless of whatever item, because this is all the things that not yet occurred. Okay, not yet occurred. So how do we know? Okay, the figures is actually going back to the management assertions or audit objective. Is a complete, accurate, valuation is properly done, is it actually owned by the company? So it still goes back to the same objective or assertions that we want to prove on. Okay, with regard to the subsequent events, Okay, another thing about significant estimate is that I would like to highlight is the provisions account. That's also another angle. Okay, provisions account. How do we do when we have provisions account? What will be the entry? Debit what, credit what? Tak kisahlah provision apa-apa. Anyone? Katalah provision for bonus. Debit account?
Bonus, madam.
Bonus kat mana?
Debit bonus expenses.
Bonus expenses. Okay. Credit?
Provision for bonus.
Provision for bonus, which is inside liability, right? Okay, or balance sheet item. Okay. All right. So you made these particular provisions. Okay. So with the idea that coming the next year, you make a payment. So when you make a payment, basically what happened? You would actually debit provisions. Okay. Credit bank. All right. Okay. So in other words, cancel off the provisions account. Okay. So this is the by right is the right entry. Okay. What happened is that client do sometimes when they make provisions, what actually happened? They debit expenses this year. Okay. Of course, credit provision account. Coming next year, okay, they debit provision account instead of credit actual payment. They credit P&L, but of course now will appear as your income. Okay, of course, it's cancel off each other. Okay, it's cancel off this, it's cancel off that. Okay, is that okay? Okay, but practically it's not okay. Why? Because it's cover different financial year. Okay, meaning that now in this financial year, the impact is that you record as a revenue, expenses. So hence, it's actually increase your expenses, reduce your profit. Okay, but when you do this entry in the following year, what happens is that now you credit to your P&L, which is now become income, isn't it? So in other words, it would actually increase your income, hence increase your profit. Okay, so this is where the element of earnings management involved, which is actually wrong. Okay, I mean unethical lah. Alright, so that's why this is happens when they do reversal. That's why as an auditor, alright, in the year that when we do the audit, for this particular year, the year that we do the audit, right, then this is where we check, is that necessary to do this adjustment or to do this entry or not? Okay, is that necessary? Right, if necessary, all right, and then the basis and assumptions is accurate, complete, then okay, we accept. Okay, but if let's say when we go to the subsequent year, sometimes when we check journal reversal, or sometimes when we check interim financial statement, we found some fishy, then this is how we come up, we detect this entry. Okay, so if we saw this and then we know that this entry in the first place is not necessary, then may as well don't do the reversal in the following year. We make reversal in the current year. I mean, in the year that you do the audit. So it will be set off immediately. Okay, all right. So that's why in the course of the audit, the reversal, okay, or journal reversal after year end or any adjustment after year end is actually also crucial for us to audit because we want to see the pattern. Okay. All right. So that is with regard to the estimate. So that's why estimate accruals provisions account is always a high risk area to audit actually. Okay, even though it's just a provision, but actually it is a tricky part. The same thing with the fair value valuation. When we go ask the client, they say that our property should be valued this much. How do you know that much is actually a accurate figure? So as an auditor, we have to check lah. Okay, that's why sometimes we go and check mudah.com or property in the area, how much is the value? Is it at the market range or not? Because normally you have the range, right? Okay, and then you assess. So as an auditor, we have to know where to look for the info. Okay, or perhaps sometimes we have to go to the valuer to get the actual value. If we think that the value that determined by the client is actually quite suspicious. Okay, so auditors always have like 6 instinct. Okay, they have the basic instinct. This one is something not right and so on. Okay, so that is with regard to the estimate. And then events. Okay, events is the one that I mentioned just now. Happen when? When does it happen? Okay, so when it happens, first we have to know what is our procedures. Okay, so you have to take note that the procedures that auditors must do is that always procedure for the completion. We ask client, okay, inquiry to the client, and then we check minutes to the meeting. Okay, because normally it's always involve meeting, okay, management meeting, board meeting, whatsoever, because if it is significant, then it will involve all this level of meeting. So you need to cite the minutes of the meeting. Okay, then you decide whether the nature of the event is actually material, and the amount is material, hence adjustment required. Okay, so and then another area that we also might want to look at is the interim financial audit, interim financial statement. Okay, what is interim financial statement? Interim financial statement is actually refer to this. Okay, this is the year that you audit. Okay, so you end. So you come and audit, let's say in the month of February or March. Okay, so by this month, client already have at least their 3 months account. okay, for the following year. So this is year 2020, so perhaps they would have 2021. So what do? We check this interim financial statement in the following year. Okay, we want to see plus minus, is it, because we already have the 12 months, right? So we can actually extrapolate to 3 months, okay, whether the performance of these 3 months tally or not, the one that we extrapolate from the 12 months. Okay, if not tally, if something like questionable, this is where we further check lah. Alright, so that's how we look at the interim financial statement. Okay, and then for the subsequent event, right, for the subsequent event, the thing is that the actions that need to be taken by the auditor is either you, number one, after you assess, no adjustment required. Okay, so these are example of the decisions that can be taken by the auditor. Okay, means after you assess, the amount is not significant, and then the event is nothing significant to the financial statement that you do the audit, then no adjustment required. All right, that means we do nothing. Okay, or sometimes we might want to have adjustment. Okay, so when talking about adjustment, the adjustment might only adjustment on the financial statement, whereby you have the debit credit entry. Okay, or maybe the adjustment would involve financial statement and notes. Okay, or maybe the adjustment would require just on the notes to the account. Okay, because that means no debit adjustment to the financial statement, but require additional disclosure. Okay, for the transparency reason. Alright, or worst scenario, the adjustment made to the audit opinion. Alright, so these are some of the example that decisions or actions that need to be taken by the auditor in the case of subsequent event. Okay, but of course, in order to come to this decision, it is actually depends on your audit procedures that you have done. Okay, and of course, if you're given the question maturity level, of course it will involve lah. Okay, so because sometimes the amount not material, then perhaps we just forget about it lah. Okay, in that sense, because it's not big impact. Okay, all right. So this is normally what we do when it comes to the cost of subsequent event. Okay, and then what else? Okay, what happened if event that happened after issuance? Okay, after the account has been signed. Okay, and also after the issuance of the financial statement. Okay, last time is even worse because last time we do for the hard copy printing. That means the issuance is actually when the annual report is being printed. But now this is the beauty of the technology, no longer printed. It's just in the CD form. Okay, so what happened is that if let's say the account has been signed, been finalized, and then already ready for it to be given to the shareholders, to be posted to the shareholders, okay, and you find some auditors based on the subsequent event found that something need to be adjusted to the financial statement. That means financial statement inside that CD is no longer valid. Okay, so as an auditor, you still want to adjust, okay, and it's accepted by the client. So what do? We come up with the excerpts. Okay, if you're familiar with the, for those who play shares, when you get that CD together with inside the folder, you have excerpts or addendum. Okay, that means they will say that, okay, whatever financial statement on this particular page must be read together with that addendum. Okay, so that means we understood. There are things that we may change, okay, to the financial statement. That means when you read the annual report given to you, it has to be in tandem to the addendum that being given to you. Okay, so that's why I said even after the account has been signed, even after the account has been issued to the client, okay, if you think that it's really need to change the information, figures, whatever, it can be done. Okay, so that's how it is actually being done in the practice. All right. So what happens if client don't want to do it? Okay, you think it's material, it has to be adjusted, but client don't want to do it. Okay, so what is our role then? Right, so if you go back and see the cases, a few cases, auditors must know the level of reporting. Okay, so in the course of the audit, all right, in the course of the audit, in the course of you doing financial audit for that particular year, regardless whether they're within the course of the audit or perhaps after the audit, you find something that client disagree to amend, but you believe it is important, have significant impact on the financial statement, then you have to report to management. If management refuse, then report to the audit committee. And if audit committee refuse, who do you report to? Then you have to report to the right authority. So of course, corporate commissions, okay, because of the Companies Act, you report to them, and apart from that, you report to Securities Commission because of your status as a listed entity. Okay, all right. So auditors must know what are the do's and the don'ts. Okay, in the case of subsequent event, because it happens. It happens in the daily practice. All right, that things happen after you end, after the day of sign, after the issuance, then have impact on the financial statement that you have actually issued. Okay, so that is subsequent event. Okay, analytical review. How many times we do analytical review in the audit process? How many times?
Two.
Dua? Dua je?
Three.
C.
Okay, first one bila?
Planning.
Okay, during planning. What happened? Analytical review during planning.
We compare the last year audited financial statement
Against?
with
Compare dengan figure apa? Current year lah. Kan? But current year, which is still very much from management account. Okay, so basically it is unaudited because you have not done the audit yet. Okay, you are at planning stage. Okay, you have not done your work yet. Okay, so basically the figures is actually raw from management account. It is still unaudited. Okay, so that is so this is where you all your financial position and also your suci. Okay. Why we do this? Because we want to assess some abnormalities ataupun something. Because by doing this, actually we can tell. Okay, we can tell actually the stories. What are the changes that happened from last year audited account to the current year performance? Okay, that's the first stage. All right, first time that we do analytical procedures. When is the second time?
during
When
fieldwork.
is the second? Sorry.
During fieldwork.
Okay, during fieldwork you do that. Okay, when is during fieldwork? This is when you do add individual item. For instance, you do sales. Okay, you do sales. So what do? You compare sales current year and last year. Okay, and sometimes you further break it out into local sales and then foreign sales. All right, and then you compare. So it's more detailed. Okay, analytical review. Okay, or perhaps sometimes you do also ratio analysis. Okay, so ratio analysis, somehow you can actually tell why this one increased, why this one decreased. Okay, at the same time, you also have to apply your understanding on causal relationship, especially when you do your ratio analysis. Okay, for instance, like let's say sales increased by 250%, but your account receivable increased only 5%. Does it make sense? And the ratio did not tally. Okay, when you do ratio analysis, of course, when you have sales, it's somehow in certain formula you have accounts receivable, right? Okay. So the ratios does not tally. So this is where it actually give you some trigger point for you to find some subsequent, additional work lah to be done, okay, to verify what actually happens and so on. Okay, so for accounts receivable, analytical review at the fieldwork stage is actually being done at every single item. Okay, that means every item on the financial statement, you will do at least comparison last year, this year, and after that, you will do detailed analysis, okay, based on whatever software ataupun version that you use, okay. And then you also see the causal relationship. Alright, okay. So that is for account analytical review at the fieldwork. Okay, so last but not least, you are doing analytical review in the completion, final stage. Okay, so if planning, you are comparing current year unaudited, last year audited. So roughly here, you already come to the completion, right? So more or less in general, all the item has been audited. So you are actually comparing current year audited and also last year audited figure. So by right, the comparison here should give a better overview of overall performance of the company. Why better? Because after audited, you already make sure that all the item, you're actually comparing apple to apple. Okay, why I said apple to apple? Because in the planning, because some client, their reclassification of the account tu, alright. So after doing the audit, only we find out we do the reclassification again. So that's why sometimes during the planning, alright, you can't tell the story because some of the reclassification which is need to be done did not been done yet. Okay, so that is where not you're comparing one big apple, one small apple, something like that. Still apple to apple, but because of different classification, it means the figures not reflect in the true picture. So the final completion is actually we give you an overview, okay? Final overview of the overall financial statement. That is one. Second, you want to check any missing item that you have forgot to audit. Okay, so it happens it happens to me based on my experience last time, right? Because like for instance, fixed deposit is a simple audit actually, but we miss it out. Okay, then when we do analytical review at the final stage, then only we find out that, oh, we did not do the audit of that item. Okay, in order to audit, it's just easy. You just go and get confirmation statement from the bank. It's already confirmed everything. Okay, the ownership, the value, the accuracy, and so on, so on. All right, so that's why I say it's easy to audit, right? But then it's just you miss it. Okay, so that's why by doing analytical review in the final stage would actually give you the overall view of the performance of the company. So much clearer, audited figure and also audited figure. So these are the three stages that we actually do. Okay, performing analytical review in the final stage. Okay, so that's why in a way your understanding of the item, the debit credit knowledge is also important, right? For you to see the relationship from one item to another item. All right, then the going concern. Okay, what is going concern? Okay, going
We want to know
concern. You want to know what?
we want to know the status of the company, whether they can survive or sustain for at least 1 year.
Status asset what? Status they are able to survive asset when?
At least 1 year after the audit year. Let's say the audit let's say the financial year end is 2020, so at least they can survive for 2021.
Okay, so the time frame is actually 12 months. Okay, the time frame is actually 12 months. All right. So meaning that you are doing the audit for year end 2020, 31st December 2020. Once you come in the middle, right? The first quarter, right? So at least you assess for the next until 31st December 2021, the company can still in existence. That is actually going concern assumptions. Okay, all right, so that is the time frame, all right. Okay, what are the indicators? Okay, what are the triggers that actually you look for? Okay, all right, let's look at your notes. Okay, number one is we always look at the profit. Are they making profit or are they making loss for the past 5 years? If they're making loss for the past 5 years and further their retained earnings is actually accumulated loss, that is really give you some clue, one indicator. Okay, making loss for the past consecutive years, and then retained earnings is also negative, which is accumulated loss. And then sales are increasing perhaps, but at decreasing rate. Okay, what does it mean? It means that last year increased, but increased by 5%. The year before increased, but increased by 7%. The year before also increased, okay, but increased by 10%. Okay, so meaning, okay, we have year. So this year increased by 5%, okay, increased by, here increased by 7%, here increased by 10%. So of course the revenue are actually increasing, but here you see the percentage is actually decreasing rate. That is what I mean by your sales are increasing, are growing, but at decreasing rate. That is actually negative. Of course, you want is increasing and at increasing rate. It means the portion that the growth is actually higher and higher every year. Okay, so this is also another indicator that we want to look for. Okay, another indicator is the cash flow. How do we know that they have cash flow problem? You see a lot of financing facilities they use with the bank, credit facilities. Bank will give money when you have money, okay, but you have to check whether you really have money or not. Okay, all right. So they use a lot of credit facilities, overdraft, okay, whatever, okay, and then they fail to pay their installment on timely basis, defaulted. They start to default the payment. That is also another indicator of having a problem. Okay, so that is on the financial side, what we look for. And then another element that we also look for is the internal matters, such as their key personnel who really know about the business, who really the one that bring customer, client into the company, resign. So what happened? Okay, you assess it. So that's why you have to get to know everybody inside the company, who is who. Okay, that's one. Second, facilities is outdated. How do you know their facilities is outdated? From the understanding of the business and industry. Okay, like last time, Nokia. I'm not sure you know Nokia or not. Okay, but at my time, Nokia is really number one in the market share. Okay, whenever people talk about handphone, always for Nokia, even though they start with the like Tumblr look, okay. So always go for Nokia, number one in the market share. But overnight, okay, the day after Samsung and iPhone introduced the smartphone, Nokia is out of market, out of business. You see, if you did not want to change your facilities, you did not want to upgrade, okay, hence you will be out of the business. Okay, same thing like Kodak. Okay, Kodak is last time a company, right? But of course, if you familiar, well, I'm not sure because your generation. Last time when we take photos in the camera, we have film. Okay, the film, the big company issue sell it is Kodak. That's why every time we say film, we don't say film, we say Kodak. Ada Kodak ke tak? Walaupun there is another brand that also selling that film. Okay, but after that, we no longer use film. Okay, it's become digital camera. And then after that, what happened is that from the digital camera, now camera is already together with the phone. So what happened to the Kodak? Out of business. Okay, people want to take photos, we don't need for film. and they refuse to change, to go along, to tag along with the changes in the environment, preference, and so on. So again, they are also out of market, out of business. They no longer exist. Okay, so that is actually why understanding of the business is actually important for you to identify the risk, hence the survival of the company. Okay, external matters, how could it be an issue? Okay, example like Media Prima. Okay, Media Prima, what they do? They are entertainment and also news. Let's say they, in order to run the business, they must have license. Okay, only company with the license can have a TV program and so on. So let's say one fine day, government retrieve back the license. What happened to the business? Okay, the business might lose the opportunity to continue with the business. So again, all right, if let's say they breach the license, the contract, whatsoever. Okay, so it could have also impact on the going concern, continuity of the business. All right, okay. So that's why when we do the audit, understanding of the business is actually very crucial. It will help us to assess the capability of the company actually to continue or not in the, at least in the near future. Okay, all right. So any questions so far? We have already come to the final item on the completion, which is disclosure. So disclosure, this is the notes, the notes to the accounts. All right. Basically, this follow MFRS. That means whatever required by MFRS to be disclosed. Hence, we must ensure that actually client disclose it according to the requirement of the MFRS. All right, and then this one is letter of presentation. This is actually to confirm that letter issued by the client for the client to confirm whatever their corroborative explanation. Okay, because sometimes that also being used as an evidence. It's actually the client actually tell the correct confirm lah whatever that their oral responses is actually accurate, facts, the truth, and so on. Okay. And then management letter, communicating to the audit committee. This is closing. Normally you would have closing meeting. Closing meetings means after you wrap up the whole audit work and then completion. And then this is the final stage whereby you think that there is some disputes issues or any adjustment that's supposed to be done but not been done by the client, etc. So this is the platform where we talk to the audit committee, okay, to discuss whether client actually have done or have not done what they're supposed to do. Okay, all right, and then last but not least, management letter. Different letter of representation and management letter. Okay, management letter is the one that we issue to the client to tell the clients these are some of the weaknesses that we found during the audit, and then we try to recommend some improvement. Okay, so some company take it positively, some company take it negatively. Okay, because for them they think that you highlight their weaknesses. Okay, but for some company, because they always want to improve themselves, so they take that comment constructively. So that's why before we issue management letter, we really have to check with the management how is their acceptance or perceptions towards the issuance of the management letter. Okay. But some company really don't want management letter because it reflect on their management. Okay, so this is the example of how the management letter looks like. Okay, and then the items, how we put it. Okay, means how auditors put it at the back. Whatever findings of the witnesses that we found during the course of the audit, during the walkthrough test, and so on. So this is where normally we put in okay, to the client. Okay, so basically that's all about audit completion that you need to know. Okay, so first you have to understand what the item that fall under audit completion, and then what are the audit procedures that normally need to be done for respective category of the item. All right, and then of course types of the decisions that need to be made by the auditor after the audit procedure. Okay, all right, so any question? Any questions so far? Okay, if no question, then you can actually give you 5 minutes for you to read through the question that I already shared with you in the WhatsApp group. Quickly go through the question, then later we will discuss how to tackle each question. Okay, finish reading. Try to think of the answer as well.
Adik-adik ke mana? Ya, tinggal dia budak tu. Dia budak tengah marah.
Okay, my presenting, sharing. All right.
Oh.
Okay, let's look at these as some example of the questions lah. How questions on the topic of the completions is being tested. Okay, let's look at the first question. Kelly Peters is completing the audit of the Making New Friends, okay, which is like online company for the year ended. So the audit manager for the past 3 years. And then issued stocks 2 years ago, but had difficulty in this establishing a loyal client base. Okay, and hence generating advertising revenue. Okay, so this is one trigger point lah. Alright, that means they actually having problem. They are online company. They having problem in getting client. And then at the same time, in reviewing the results for the current year, they noted operating loss for the past 3 years. So this is the second trigger point, lost for the past 3 years. And then the third trigger point, working capital ratio is declining from 1.2 to 0.9. Okay, so this is the third trigger point. So by reading this, actually it can already trigger to you. This is actually talking about what? Talking about problem of the company to continue their business. Okay, so in other words, it's actually a going concern issues. Okay, and then they indicated that, so those three are the trigger point that further strengthen there is an issue of going concern because they cannot get new client, they're making loss for the past 3 years, and working capital ratio is decreasing. And then they indicated that they plan to obtain debt financing. Okay, again another what? Of course, when you are not making any sales, okay, you don't have cash, right? So you are having cash flow problem, okay, because you try to get financing. Okay, so those are the 4 trigger points that actually being highlighted inside the case. Okay, and then however, they have not yet secured financing with the bank, and management indicated that they aggressively pursuing new advertising contracts. So this is management plan. Okay, all right, so you have the 4 trigger points and then you have the management plan. So what do we do? Okay, let's look at the question. So A, according to the auditing standard, what is the auditor's obligation? Okay, in order to consider whether the client can continue as a going concern or not. Okay, what is the auditing standard say? Okay, with regard to the completion, it's one of the area that you must assess, right? Okay, so basically you have to say that it's a areas that you must assess in the course of completion audit. Okay, it means to assess the going concern of the clients. Okay, B, assuming management is using GAAP, okay, MFRS, for instance, in our context, what time period is the auditors required to consider? Okay, so like just now, okay. Sorry, when I open, I cannot see who is actually answering, but the system mentioned just now, the period is actually starting from when is your year end date? If your year end is 31st December 2019, so actually you are actually assessing from 1st January until 31st December 2020. So that is the period where you assess the company can continue their business or able to continue their business existence. Okay, see what are the factors that discuss to relate that there is a going concern assessment. Okay, so I already mentioned just now the 4 trigger points. So this is where you actually supposed to highlight. Okay, you are supposed to highlight. And then here they mention about additional information. So you can actually say lah what are the additional information that you might want further to investigate in order to assess whether they are actually capable to sustain their business or not. Okay. And then what are the responsibility of the auditor with regard to the management plan? So management already mentioned their plan is to do aggressive getting new client, okay, to increase the revenue. So what the auditor need to do? Of course, auditor need, because the moment auditor find all the trigger points, immediately auditor would actually conclude there is a going concern problem. So when there is a going concern problem, auditor will think of what? Okay, include inside the notes to the accounts or is change your audit opinion, or maybe include inside your audit opinion as an emphasis matter. Okay, that is where the client try to refuse lah in a way. Okay, because it reflect their reputation, their image and so on. Okay, so now only they will present you the management plan. So what do? We get the management plan and then we assess, is it reliable? Okay, is it workable? Right? Because sometimes people can always say, but how they do it, how they execute. So you assess based on your judgment. Is it workable? Is it feasible? And so on. All right. Okay. That's basically how you answer the question. Okay. But first thing, when you read that, you have to know what is actually the issues or which part of the audit completion that it is actually being tested. Okay, this one. Okay, let's look at the first one. The company's financial statement did not include accrual for bonus earned by senior management in 2019 but payable in March 2019. Okay, what happened here? Okay, this is 2019. All right.
Error of omission.
Sorry again. Repeat please, your answer.
Error of omission, just did not record it.
Okay, they did not record it. So what will you propose to the client? Their bonus here for 2019, but payment made in 2020. No record. What will you propose to the client? What would be your decisions?
General adjustment.
Okay, you propose to make an adjustment, right? So by right, this figure should actually accrue here. But would I accept if you said no adjustment required? Okay, sometimes there are students that say that no adjustment required because the amount is not material. Okay, right? But here is clear cut, it has already incurred. Okay, that means you already made payment. So for sure it's going to happen. Right, so that's why regardless whether material or not material, normally we will try to push for auditor to, for client to recognize it. Okay, all right. So that's the first one. Second one, equipment originally costing 725,000 was fully depreciated with a remaining book value of 60,000 and was sold for 85,000 on December. The purchaser agreed to pay for the equipment by January. So what do we do in the books of the account? This is talking about disposal of fixed asset. Any adjustment required or not?
Yes.
Apa yang you nak adjust? If you want to adjust, what do you want to adjust? How you want to adjust?
Disposal of asset.
Okay, disposal asset, but has it taken up yet?
I think no.
No, it's not yet taken out, right? Okay, so that means, in fact, this is actually not your liability. Okay, so on prudence concept, by right, it's relate to your assets. So by right, it's not actually on the prudence concept. Okay, you can actually say that not required for adjustment. Okay, so you only need to take up the transaction whenever the actual payment is actually happen, which is in the following year. So in other words, there is no adjustment actually required for this item on the financial statement for year end 2019. Okay, what about the third one? Based on the close examination of AG, okay, the allowance for bad debts is overstated. So what do we do? Meaning what? An allowance is overstated, so your account receivable is actually understatement, right? So there is an understatement of your assets. Okay, so do we make an adjustment?
Yes.
Okay, so you can propose that there is an adjustment required, but sometimes I also accept lah, okay, because sometimes you say that it is you assess on the materiality, all right. Then if you say on the assumptions that materiality amount is smaller, then perhaps no adjustment required. Also, I do accept. Okay, but of course it depends on how you make your justification. Okay. Alright, but of course the best is for you to make an adjustment lah, okay, to reflect the true picture of the assets. Okay, number 4, expenses totaling 52,000 associated with the maintenance of the equipment were inappropriately debited into equipment account. Any adjustment required? Is that an issue? If that is an issue, what is the issue?
Is it the understatement of asset, madam?
Yes, it is actually understatement of assets. It's actually wrong classification, because now, now pula understatement, your overstatement of your assets. Okay. It is actually expenses related to maintenance of equipment. So it is actually supposed to be expenses, but you put it in your assets. Okay. So later when you learn about fraud, this is one of the area where trigger point for suspicious lah. Alright, because you capitalize your expenses. Because by right, expenses should be captured in the expenses account, should not be going to assets account. So here you overstate your assets, hence you understate your expenses. So of course, propose for adjustment of reclassification. Okay, marketing number 5. Marketing expenses incorrectly classified as a cost of goods sold. Both are expenses. So, do we adjust? Or do we not adjust?
Adjust, madam.
Okay, we adjust. Okay, why we adjust?
Because it will because it has overstated the cost of goods sold.
Okay.
And, yeah, and
And
it affects the income lah, the net income, I think. Yeah.
Mana ada final income?
Incorrect
Gross.
classification.
Is it affect your net income ke? Kan, it will
Yeah.
affect your gross profit margin and also gross profit.
Mhm.
Okay, careful Habis apa? Okay. So what happened is that here, that means you overstate your cost of goods sold, hence you understate your gross profit. So in other words, it will affect your GP margin. Therefore, it is actually advised to go into the right classification of the expenses. Okay, but of course, at the end of the day, net income still the same. Alright, so be careful. Okay, last but not least, the company received new computer equipment, having ordered, received equipment on January 3rd. Okay, and then the order, everything purchase, maknanya the purchase PO semua tu occurred on the December. Okay, no entry has been recorded, but which was financed by the long-term note payable due in full June 30th, 2021. Okay. What do we do? What do we propose? Anyone? This is purchase,
I think we the client should, or we should record the purchase by December 27.
Okay, why?
Could it be because it's on FOB basis, so like because of that we have to recognize the asset that we purchased on the date itself that we make the purchase, or
Okay.
when it's shipped to the port Westmoreland.
Okay, first, if you want to record, of course, first you have to see the document that you want to recognize your liability purchases. Okay, is it based on the purchase order? Is it based on the invoice, supplier invoice or whatsoever? All right, okay, that's one. That means the basis of recognition. That's why I can't remember which topic. I think forgot. All right, actually goes back to your accounting process lah. Okay, what is the basis that you use in order to recognize your assets? When is the sales, income, assets, liability? You must have a basis. Documents. In this case, you're talking about purchases. So normally purchases is actually recognized based on which document. All right. So hence, if that document is actually issued before year end, therefore by right it should already be captured, okay, by the financial statement. Okay, especially when it's actually financed by the long-term note payable, meaning that it actually reflect the contingent liability or liabilities lah. That means you already foresee you're going to have that liability in the near future. Okay, all right, because normally when you have long term, normally you split amount, short term how much, long term how much. All right, so you have to disclose that. Okay, so meaning this adjustment will be required, and perhaps if you know, you can actually also mention about disclosure about the 12 months and also the next more than 12 months disclosure on the long term note payable and so on. All right. Okay, so that should give you some idea lah how you should tackle the question. Okay, so that's why it goes back to your understanding of the accounting transaction, how to record, what to record, what is the basis that we use, okay, which account to debit, credit, and so on. So it will actually help you to be able to answer better in addressing the issue, especially when we're talking about, in this example, adjust kena adjust. Bila part tu yang mostly students, some students are not able to detect because I don't know, perhaps accounting knowledge need to be strengthened further at that part. Okay, so that's why understanding of the item is actually very